right. Good morning, everybody. Thank you guys so much for joining. I am Noah Rosenblatt. That is John Walkup. We are both with UrbanDigs, and it is Monday. You're going to get a little macro Monday coming right at you. For those of you that are new to this show, we're going to start out with Manhattan real estate, take a look at the 30-day trends of the data, and then we're going to go to a whole bunch of macro topics I got up there, and we're going to circle back to Manhattan real estate, and we're going to try to do all of this within 30 minutes or less. Yeah. This is your opportunity to, guys, ask us questions, comments, live stream right there. Johnny's got eyes on. Eyes on, Johnny.
Yeah. See, Noah's got the hard job. He has to cycle through all the charts. My job is to keep an eye on the comments. Let's see if I can get my job done today. I've got one job, and sometimes I just don't quite get it done. But I'm on it. I'm on it today, Noah. I'm feeling really
Stay on it. Stay on it. And one last bit of housekeeping here, guys. We're going to talk about some macro financial stuff, but none of the stuff we're talking about is financial advice. Do not start day trading this stuff. Okay. Johnny, you ready?
I am ready. I just want to amend that to say, listen, if you go back and like in 3 months from now, we're spot on, it totally was advice. So you just didn't listen to us.
Okay. If we're right, it's advice. If we're not, it is not advice.
That's right.
That's how we roll.
Entertainment value only.
Let's start out as we always do, guys. I'm looking at the market snapshot right here. I'm looking at the market ticker. I am looking at 1 month trends. You guys can do this yourself. This updates every single day. I see 30-day supplies at 1,010. We're supposed to end the month of July at 1,171. We're already 10% below.
Yeah, I don't know if we're going to get there. I'll be honest. No, I mean, it just seems light, and it seems like it's getting lighter. So I don't know.
Yeah, and that's what's going on that one. Yeah, and that's why the pulse has been kind of rising lately, even though you feel like the market is maybe not feeling. I'm not feeling that right there. It's because supply is falling faster than deal activity. They're both falling, but supply is falling faster. So that's why that's an upwards push on that pulse right there. It's a supply driven thing. But yeah, this is low. This is light. I don't know, man. I don't see July being a heavy listing month. So
it doesn't seem like it. I mean, listen, supply has been hugging its seasonal trends for the last couple of years or so. It's just there's no story in supply. I think that if you're going to pick a side, it's on the lighter side. So we've seen some heavier months in supply. We've seen some builds, but it looks like going forward, I'm kind of on the side where it's going to be light.
Yeah, I'm going to load up this supply chart and let's just take a look. I mean, let's take a look. Last year, we're over here, right here. Okay, so we peaked out right about June, and it went down to, what's that, 5,700 at the beginning of September. 5,700 at the beginning of September. The year before that, we went down to 5,979 beginning of September. Okay, I could just keep doing this. This bottom line, what's this? Beginning of September, right? Okay, so this is going to go down until the beginning of September. And it looks like, again, last year, 5,700. The year before that, 5,900. So we're starting at a lower point. I feel like we're going to go below that. That's what I feel like by the time early September comes.
It was an interesting build, right? If you look at the previous trough, I guess if you're going to think about these things as cycles, you look at that previous turning point. So you go back to the right, Yeah, that little low point right there, that trough. Yeah. No, to the left. Go to the left.
What?
Go to the left, a little V point where supply starts.
Man,
that run from the low to the high. Well, I'm trying to. You go from the low to the high. That was an extended run in terms of supply. Like there was a period of time where supply sort of built over a longer period of time compared to some of the other seasons, from the low point to the high point. And it looks like it's just run out of steam and it's starting to come off, typically seasonal patterns. It comes off starting in mid-June. Supply in August, supply tends to fall. It's fine in July and August, and that's where we are. And we could have a faster fall, especially if contract volume doesn't keep up.
Yeah, and I don't know. We'll see about contract volume in a second, but this shape is what we're expecting for the next couple of months. So this is just going to go down. It's just going to go down until early September, and I would not be surprised to see us take out that low of 5,700. So we'll keep an eye on that. Let's go back to the dashboard, John. Let's go over to contract activity. That's our measure of demand for 30 days, 1 month, 887. That is supposed to be at 917. And you can see the liquidity chart right over here. We're now down 5% last year. down. I always like to look year over year. Like, where are we this year? Or where were we last year? And like, look, this was up. Like, for the majority of the spring season, right? Like, February, March, even April and May, this was up. Like, we were up year over year. We faded. Definitely a weak end to the spring cycle, John.
It is. I mean, it was sort of the air was let out of the balloon in April and just kind of kept hissing all through May and June. But what's interesting, you talk about that year over year. That's what to me was interesting last summer around this time. We were kind of watching liquidity almost moving sideways. It was ticking down, but it wasn't sort of down 5%. It was sort of up where it was last year. So it looked like there was a bit of a story that was emerging in liquidity, and it turned out that turned into a bit of a run in the fall and then a little bit of an early run in the spring before, Liberation Day. Doesn't look like we have the same thing on tap for this summer just yet. Yeah.
Uninspiring into the spring cycle. It is what it is. But, for those of you that are heading into this summer with sales, they need to make some decisions. I know a lot of sellers are tapping the rental market. They're going off market and they're doing major price amendments. And this is kind of what you got to do if you have to sell right now. The market is just a little bit of a problem. All right. It's a little bit of a problem. That's unfortunate, but it is. All right. I'm going to shift. If there's no questions, I'm going to shift, Johnny.
Good to shift.
Let's get right to the macro portion of the program. This is credit spreads, guys. This is not credit rates, mortgage rates, credit score. That's not what this is. This is credit spreads. All right, let me put my max chart up here. I always say to myself, I'll start out this way. That's credit spreads right here. And if you just go back in time to 2009 and 2020, you'll see how this thing's rising, right? This is the spread between corporate bonds and U.S. Treasuries. We look at this spread because the market is going to give a different rate to corporate bonds than they're going to give to U.S. Treasuries. U.S. Treasuries are safer. That rate's lower. Corporate bonds are riskier. That rate's higher. So there's a spread. And that spread is always widening and narrowing. And if it's widening, that means that this little credit spread index that you're looking at in the middle here, that means it's moving to the right. High. See, high credit stress? That means it's bad. That means this is going up, okay? We are way down here on the right. For reference, you could see what it did during the pandemic, and for reference, you could see what it did during the great financial crisis. So when this goes up, it's bad, right? So now when I look at the 1-year chart of what we did, down good, risk on, up bad, risk off, take a look at Liberation Day in April. That's nothing happened. It didn't go further than this level in time. And if you think about the markets, they've kind of recovered. We haven't recovered, but the tradable, riskier asset markets have recovered, John. Credit spreads, they're coming in. We're at stage 1.6 now. This is a new low for us the last year or so.
Yeah, and the reason we like to watch these is it's essentially the canary in the coal mine. These will start moving before other indicators typically start really flashing danger signs. You'll see it here first. So that's why we like to watch these. But I'll be honest, like a few weeks ago, I was thinking the bias was to the upside. I thought there was a lot of uncertainty ahead of us. We've since ticked down. I still think there's more room to run in terms of the upside on credit spreads. But look, I can't argue the fact. Look, over the weekend, right, July 4th, they passed the One Big Beautiful Bill. So that I think has the effect to lower credit spreads because I think it takes away the debt ceiling headaches and all those negotiations of the summer that we used to like be hand wringing and wondering if it's going to happen. And credit interest rates would rise on that. That's off the table. So whatever the good, the bad, the bill, whatever you want to think about it, I think it's lowering credit spreads because I think it has taken some of the uncertainty out of the room to lower these. I think it'll probably raise rates long term, but I think it's going to lower credit spreads right now. So plus the economy looks like it's okay, right? We had unemployment rate come out, tick down. So it's like there's good things happening, I think, are lowering this number. So it's a good sign. This number, this spread is headed in the right direction, which is narrowing. So I'm glad to see that.
Yeah, and you said something very, very important, and I think that's what's going on here, guys. It's not even about the bill. I mean, there's a lot of things that are messed up in that bill. It's about the fact that it's over.
Yeah,
like exactly. It's a fact that uncertainty was removed. Markets trade on uncertainty, certainty, expectations, stuff like that. Guidance, expectations. They look ahead. These markets, they don't care. They look ahead. Right. And as long as something is not going to become a major problem, they just don't care. They shove it aside and they move on. They go look for the next thing kind of a thing.
Yeah.
And credit spreads are reflecting that. Then thank you, John, for pointing that out, is that it's removing uncertainty. It's removing some of these risks and their expectations are managed. And here you go. This is the bond market's reaction to that. And I want to point something out. Yes, John, you have been wrong because you're saying credit spreads are going to go up. And I said credit spreads are going to go down. Okay. And I'm going to say something else. This is the most hated rally ever. No one believes it. Which to me, the pain trade is up. The pain trade, guys, when I say the pain trade, I think like a trader. John thinks like a trader. We're both like traders. The pain trade is like the consensus trade kind of a thing. It's that everyone's kind of in the same kind of trade. The pain trade is up. You know what I'm saying? That's the most painful element. It's going to go the other way. No one believes in this whole thing. So like when I look at credit spreads, we could still go lower. Like look at where we were in 21 and 22. Look how low this got. So that's my point is I still feel like this could go lower and risk on. It could surprise. This thing could go on for a little longer until it doesn't, but we'll keep track of it. Okay.
Well, so yes, I agree. The reason I still think that there's a bias to the high side is because I think you're certainly right. We have removed that uncertainty, but that's sort of that known uncertainty. And I think we still have a lot of uncertainty that remains in sort of that headline risk. Like I know we talked about tariffs. I know that sort of stuff feels like it's on the back burner. It almost feels like it's resolved, but we're only one headline away from some crazy announcement, whether it's our administration, another country, who knows what it is. We're only a couple headlines away from this thing spiking right back up. So that's what I'm concerned about. I think that genie is still out of the bottle and could, come back to trick us. But look, I mean, the 10-year is up about 10, 15 basis points, I guess, since Friday. So interest rates are moving higher on this, but the question is, how long and how high can they go before it endangers that rally that you're talking about, that pain trade? So I don't. Yeah,
I'm glad I don't know. I'm glad you talked about that interest rates because interest rates are moving up a little bit today, but you know what? They've moved down a lot, and I want to talk about that a little bit. Let's pivot to interest rates, John. Let's go to our Fed Watch tool, guys. This is our interest rate portion of the program. To do that, we're going to CME Group Fed Watch. You guys could do this yourself. I'm looking at the probabilities table. Guys, we are here. Okay, whoop, we're there. Could you guys see this table okay? Do I need to make this bigger?
Yeah, maybe you can zoom in a little bit.
Let's see.
You see how you do zoom in these days? You gotta do the pinch zoom. Like the physical movement is now like shorthand for zoom. You gotta zoom in.
All right. Well, I got to make sure that sometimes I go to the next stuff on here and it's zoomed in too much. But anyway, let's just focus on this for now, guys. We are at this level right now. This is where the Fed funds rate, FFR, Fed funds rate is at 425 to 450. They call it basis points, 425 to 450 basis points. But guys, just put a little dot next to the 4 there. It's 4.25 or 4.5. That's it. That's Wall Street trying to be different. Now, July 30th. This is the meeting dates in the future, guys. These are all future dates. Okay, July 30th. We haven't gotten there yet. Okay, July 30th, 95% chance that we're in the exact same column. So no change. September, I mean, this is pretty much, this went down a little bit, but 64.5% chance that we're going to get our first cut in September. I feel like the markets are expecting that cut. I feel like the markets might get a little disappointed if that cut doesn't happen, but we'll see. September, quarter point cut number 1. October, no cut. Look, it's going back and forth. Look at 44% here and 41% here. So it keeps going back and forth. October, no cut. December, cut, 43%. Okay, so I want to stop there. 2 cuts, September and December. I don't want you guys to kind of look further than that because you're going too far out. John said you can wake up tomorrow and have a headline and that changes everything. That's very true, right? Too far out and you're starting to get below 40% here, even 43%. I don't really trust that, guys. Don't start telling clients based on those low numbers here. Okay. Just be careful. 2 cuts this year, September and December.
I'm curious. I don't think we're going to get 2 cuts. I think 1 cut. It looks like 1 cut to me is penciled in right now. I still wouldn't be surprised to see no cuts this year, but like I'll go with, I don't want to fight the tape here. Look, I'll give you 1 cut. More than that, color me skeptical.
Yeah. And you know what? I let me get rid of this. I kind of feel like somewhere in this range is where we're going to end up, which is, I guess, is 2 cuts, right? Because you got to go here and then there. But I wouldn't be surprised if you're right, Johnny, if we only get 1 cut and then it stops. Yeah, and we just stay there for a while.
Leads me to mortgages, right? I think we have a big segment on mortgages coming up, but the idea is that rates are pretty stable here. I don't I don't necessarily see the Fed cutting because there's no reason to stimulate an economy that's already doing well. So unless they need to cut, which that's another problem all in itself, like it looks to me like rates will be mostly going sideways for the foreseeable future, unless that spread between the 10-year and the mortgage rate starts getting cut, which that could lower rates a little bit, but it doesn't look like we're going to enter some new downtrend in mortgage rates anytime soon.
Yeah, it's a really good point. Whatever this rate cut campaign lies ahead of us, it's just 1 or 2 normalization cuts, maybe 3 if it gets really, but like it's not some extended rate cut campaign because the economy is weakening. It's not that. So keep that in mind. Rates are down. Look at the move down in rates. And you know what? Remember I did a couple of weeks ago, I think last week, the week before, I put this channel up there, guys. We were in this channel, this whole time. We kind of broke the channel. And we're kind of at this little lower level right now. So I think I'm assuming that buyers are feeling lower mortgage rates. I don't know if they're pulling the trigger on it, but rates are down a little bit, John.
Rates are down a little bit. And I always like to see the jumbo coming close to the 30-year fixed. So, the conforming rate. So typically what that tells me is you could get a little bit of a decrease in that cushion between where the 10-year is and where they price the mortgages at. So we could see a little bit of compression there, but I don't think we're going to see a return to those lows that we saw, the sub 6% mortgages. I don't think that's going to happen. I don't think that's in the cards. And I certainly wouldn't, break out the date, the rate, marry the house kind of talk.
No, don't do that.
Anything in the pike here that looks really attractive.
Yeah. We probably have to expand downwards now that we're in a different channel. Like if I thought we were in this kind of a range beforehand, something like that, I would probably update that to like something like that or something. Just shift it lower now, guys. Shift it lower. So we'll see what happens. And this is going to be a mortgage heavy macro Monday. I'm warning you guys. I don't want to load you up with inflation stuff. I want to talk about mortgages. I want to let you guys know about what's going on with mortgages across the country. Stuff like this, guys. 71% of all outstanding mortgages have a rate under 5%. Okay. And here's the breakdown. 20% under 3.
That's crazy.
It's crazy. 33% between 3 and 4, 17.9% between 4 and 5. You add those up, that's 71.3%. Hopefully the math is correct. Otherwise, I blame this guy right over here. It's mortgage rates would have to go down somewhere to like 5 to 5.5% or something for these guys to probably consider moving. Forget refinancing. That's out of the question, right? Refinancing, like who's in the money to refinance? Like no, chances are you get a lower rate than what's currently out there, so you're not refinancing. But the structure of the housing market is just, I don't know how this doesn't limit supply for the next 3 to 5 years.
Oh, at a minimum. I mean, I think that's my big takeaway is there's so many people that is locked. That mortgage lock-in effect is not going to be easing anytime soon, unless prices go so parabolic that they're like, yeah, gosh, I'm making so much money on the sale of the house. I might as well buy this other one for free, essentially. But I don't see that happening either. So it seems like we're kind of that supply factor that we talked about. I mean, it doesn't look like it's going to budge, at least on the national level, unless it can be augmented by new construction.
Yeah, which is interesting in and of itself. And I also think this is really interesting. I actually have my little slides mixed up here. I should have went here first, guys. What's going on in Manhattan is also going on outside. That's one thing that's actually consistent about the national housing market and the urban housing market, the vertical housing market of Manhattan, is that the cost of renting is much lower. That's that blue line, monthly rent by the Zillow CPI rent indicator. The cost of renting is noticeably lower, and you have to gap up to get that cost of ownership. You have to gap up. And that's kind of, the thesis for this New York City real estate is that the rental market's going to have its moment. We've talked about this a number of times for the next couple of years. The sales market's going to continue to go sideways, maybe even bump down a little bit, right? Knowing this until these meet and the numbers make more sense. But the same thing's happening outside. The only difference is a lot of housing markets outside are already in notable correction territory. So
it's really interesting because, you look at just looking at the slope of the rental line, it was very, very stable. It's only post-pandemic that it just started really ratcheting itself up at the same time.
Yeah.
Home price wrapped up. And typically it should be cheaper to rent over the short term than to buy. And at some point it should flip. And look, either rents are going to go up, prices are going to go down, or maybe we're going to get a little bit of both. But what's the movie? Something's got to give. It's, we're at that point.
Something's got to give. And I think that's what's going to happen. As I think, well, no doubt rents are going to go up. No doubt about that. And I think this thing right here, mortgage rates are probably going to tick down a little bit. Housing prices are probably going to tick down a little bit. This is probably going to go down a little, and this is probably going to go up a lot. And they're going to meet, somewhere in the middle. I mean, look at what happened over here. But it's just an interesting take that what's going on there is also going on here. And this is another look at it, right? Because outside of our market, there's this housing unaffordability thing going on. I mean, like a lot of younger people cannot afford houses, right? Here's where we are now. Look at, okay, imagine home prices don't change, 0%. And where mortgage rates are, about high sixes, right? Mortgage rates are high sixes. That's this right thing. That's where we are now. That's your monthly mortgage payment, right? That's like we're kind of taking this chart and looking at where we are here. Well, what has to happen to get to a affordable place? Well, two things. Number one, mortgage rates need to drop to about 5.5%. That's what we were talking about before. Mortgage rates need to drop to about here. Okay. And then home prices need to fall 15%. And that brings you to this kind of target level of where this is. So it's an interesting take about what's going on. And this is actually happening outside of our market. We don't see prices falling 50%. We see record prices coming in right now, which is crazy because you probably don't feel that.
Well, the flip side is, you might not, you could keep mortgage rates where they are. You could keep prices where they are, except you could grow incomes. That's one thing that could happen, but that's a much slower process. The other is that, you think about all of the changes that were made to the mortgage industry post Great Recession, right? The DTI, loan to value numbers, those could get revised to make mortgages more affordable. You could borrow more against your income. Like that could happen too, to kind of make stuff more affordable. But again, that's not really, I think, a proper cure, because I think that'll probably just lead to yet another disease sort of thing that we had, the Great Recession. So it's this, I think, the old adage is that the cure for high prices is high prices. So I think in a lot of these markets, that's what's going to have to happen.
Yeah, it's going to be really interesting to see this play out, guys. And this is just stuff that you probably knew. I just want to show you some charts because it's just incredible to see the structure of where the housing market is right now. This is what tells me it's not going to be the housing sector that undergoes any kind of bubble collapse or something like that. The number of U.S. mortgage borrowers in the money to refinance. Just think about that for a second. In the money to refinance. If you own a house, you got a loan. In the money means that you could refi at a lower rate. That's what that means. Okay. So how many people out there today could refi at a lower rate? Well, rates are in this range over here. So you go to the left, you're at like a million borrowers out of 19 million borrowers kind of thing. And look at where rates have to go to unlock all of this kind of thing to refinance. It goes to, like, my takeaway from this chart is that supply is going to be constrained for a period of time in housing. That's my takeaway.
Yeah, I completely agree with that. And it just doesn't look like there's any reason for anybody with a sub 5% mortgage to say, all right, I'll sell. Unless, again, prices have just gone so high up that it makes financial sense. But that doesn't look to be the case either. So,
yeah. Meanwhile, mortgage purchase applications are actually starting to come back a little bit, but they're at low levels. But you know what? Like, I look at this chart, it looks like it's coming back a little bit, but our thesis here is that we're somewhere around this period of time for the sales market. Just put it into perspective for Manhattan real estate. Go back to 2011, 2012 kind of a thing. What happened over the course of the next 2 years? Not much. It was really like 13, 14, and 15 where we saw some really big moves. So the idea here is that, we're coming back here a little bit, but I don't know. This is probably in a multi-year downtrend before it has another real up run here. But it's still nice to see that some buyers are coming back.
And look, I'll take the tick up any day of the week. That's great news.
Okay. I told you it was mortgage heavy. All right. And this is the last chart, housing year over year shift. National housing market, 50 metro markets. 50 metro markets, a lot of lines to look at. The yellow line is the average, is the aggregate. It's basically on the verge of going negative, guys. It's on the verge of going negative. So on the aggregate, you got to think about that. This is probably going to be negative for another couple of months. And again, I'm sorry, the housing market outside our market, a lot of markets are experiencing downturns right now. So we'll see what ours looks like.
Well, there's a huge amount of volume post-pandemic when mortgage rates are at their record lows. We had a massive amount of people jump in, as we saw, to low rate mortgages. So there's going to be sort of an indigestion period after that as prices recalibrate to higher rates and those people are locked in. So I'm not surprised on this aggregate level to see that. I mean, you look back even to the Great Recession, we didn't have that sort of volume, but it you can see in terms of the heights of the lines, but you can see it went negative and it stayed there. So there's usually a period of, indigestion, I want to say. After you get that spike up, you usually have to figure it out for a few years. So yeah. I'm hoping it's going to be a little bit better this time because we don't have the shenanigans that went on in the mortgage markets back then. So hopefully this is, not the kind of thing where you're going to see foreclosures and people selling underwater, but it might be a little bit rocky for some markets for the next several years. I could see that.
Yeah. And you know what, for our market, I could see us going into another low volume period. I know you guys don't want to hear this, but that's how we ended spring, right? We started with a bang and then we ended with lower volume than typical for the spring season. And that's really what defined our volume trap from 23 and 24 is a lower volume, and it just was slow. It's possible and likely that our sales market continues to be like that for the foreseeable future, making it a little harder for us brokers to bridge that gap between bid and ask. Right. Even though that spread's only 4 or 5%, there are certain properties that are being more penalized, but it looks like whatever we're experiencing now is here to stay a little bit. So we got to adapt. Now, on the bright side, the dollar, okay, this is the dollar index, the US dollar. I know you look at the whole chart here, but look at 2025. Look at the last 6 months. The dollar index has just gone straight down. So, John, you were bringing up a point of whether or not this might stimulate a little foreign investment in Manhattan.
Yeah, because if you let's just put all talk of housing affordability to the side and talk about the new development market, which has nothing to do with affordability whatsoever. That's a separate conversation. So, the new dev market, it's trading on average median or so north of $2,000 a square foot when it's denominated in its native US dollars, right? But if you start converting that to other currencies, right, like pounds or Swiss francs or euros, you can see that that line is different. And especially if you focus on the Swiss franc, right, this is the lowest point in terms of new dev's price per square foot. You have to go back to 2015 to find sort of that value when you denominate new dev in Swiss francs. So it could be an interesting setup as our currency is falling against some of the other major world currencies to become maybe a beacon for international investors once again. Is it going to happen? I'm not sure, but it certainly does look attractive if you're in Swiss francs and you've got some sitting in your bank account. I know I do. This is one of the problems I face. What am I going to do with my francs? New dev actually kind of looks interesting here. I'll be honest.
Okay, well, I defer to the group out there and any live people out there. Are you guys hearing any increase in interest from foreigners looking to invest and take advantage of the weaker dollar? I don't know. John's right. Some of these prices are attractive in foreign currencies here. I don't know if they look at Manhattan though the same way that they did 6-7 years ago. Maybe it's changed as well. So I don't know. Policies and all that kind of stuff is changing how investors look at our market. So
what's interesting is that if you buy it when the dollar is weak and the dollar does reappreciate, right, you'll be earning that income. If assuming you buy it and you rent it out, you'll be now earning income in dollars, which can then be converted back to your currency at a more attractive rate. So it could be a win-win for some international investors, depending on your currency, right? If you're in Japanese yen, it doesn't look so good, but Swiss francs looks pretty good. So.
Yeah, that's the idea, right? Is you buy while the dollar's weak, and then you kind of hold it while the dollar appreciates down the road. So, safe haven play, excellent safe haven play, especially for people that think there's gonna be a risk off in the markets. Could be a good play there. All right, I'm curious, John, if there's any comments on that, please let us know. But we're back here.
Someone writes in, they say yes, cash deals, low offers, international investors check in moderately. So There you go.
Yeah. I mean, I bet you everyone's seeing different things out there, but we like to hear, you guys are on the front lines. We like to hear what you're seeing out there. And I want to close out with a couple of charts that you need to know about. Sorry, twisting my tongues here. I want to talk about sales data first. And I mentioned how prices were near record highs. I want to show you what I'm talking about, guys. We are in a fragmented, shifted period of time. Okay. Fragmented, shifted period of time where the sales data that is coming in right now, look at the orange line going across. It's like at the highest point. That's what I'm talking about. Okay. This sales data does not represent today's climate. It represents the climate as it was 3 months ago.
Yeah.
So
I'm glad you brought this up, Noah, because this is the time for quarterly reports, right? You get the second quarter quarterly reports. They're all coming out now, and they're all going to say like, wow, record prices are up. But again, you got to put it in context, because you'll have sellers saying, well, wait, I'm on the market. I'm not getting my price, but it says there's record price. It says the prices are up. What's going on? And you hit the nail on the head. Just hadn't said that in a while, so I thought I'd sneak that in. But the idea is that the sales data that makes up those second quarter reports, different period of time, different market. So
different time.
It's not apples to apples.
Yeah. If you think about where we are today, I would probably say we're somewhere like around there. Maybe we're at this level. I don't know. It's hard to tell with these things because there's so much data and it looks at median. But I can tell you right now that the pricing action that I see right now, which is up 1% or 2% from year over year, is probably not what people feel. What people feel is probably this climate index. And we got a new chart, a new bar in for this monthly chart. I want to show you guys. This is telling us the temperature of the listing climate. I'm going to end on this right over here. And the green line, as the bars go up, it's an easier listing climate for sellers. It's easier. They can get away with it. It's more successful contracts being signed, put it that way. As these bars fall, that blue line is a challenging listing environment. It's tougher. So this is probably how the market feels to you guys right now. And yes, we're back at challenging. And this is right when those high prices are coming in. So that's the confusion that I'm talking about.
Yeah. Okay. And you can see that April bar was way ahead into the easy market. It was like definitely a different period.
March.
And then April, May, June, boom, boom, boom.
April, May.
And now we're in summer. So typically you don't necessarily have, easy listing climates in the summer, simply because the buyers are not here. So yeah, correct. I can understand there might be the feeling of stagnation out there, despite the quarterly reports coming out saying, rah, 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 look at prices, aren't they great? So
that's the thing. These quarterly reports are closed sales based. Not a lot of quarterly reports talk about the current listing environment. They talk about closed sales and they analyze everything there. So just keep that in mind, guys. It's very, very important that you bridge the gap. Okay. I put up this 3 takeaways, new monthly charts in. I put this up a couple of days ago, 3 takeaways that you need to know about talking about that climate index chart, along with price action, along with listing discounts. So that's there. Tomorrow, Tuesday, we're going to talk about content and marketing strategies using data, in case that floats your boat. Okay.
Yeah. I have a question here. Noah says, can you do a workshop live event about private listings in New York City?
Oh, that's a hot topic for sure. I mean, I could.
It is a hot topic.
I wouldn't want to be the one talking. I would want to be the one asking questions or moderating. I would want to bring in a couple of experts or both sides, I guess, one this side and that side. So if you have any ideas who might be the right person to talk about this situation, email us directly. Noah or John.
I think we get Spencer Raskoff on.
Oh, no problem.
Get Zillow on, get Compass on. Okay. Let's just have them talk it out on one of our shows.
We'll just get Refkin and Spencer Raskoff and a few other high level people. We'll just get those guys on because they're huge UrbanDigs fans. All these guys.
It's just a meeting of the minds. That's what we're all about here.
Yeah. No, I got to find some people. I got to find some good people to talk about it. Independent, well, they may not be independent, but they have their thoughts and their. I guess they're not going to be independent. So forget that whole thing. But bias or no bias, I need people that know what they're talking about on both sides of the coin to do that.
Yeah, but it's a tricky, right? I mean, it's from the point of view of I'm a huge fan of transparency. I like everything to be sort of out in the open. I'm not a fan of private listings. I think I've made that clear. They're not really my cup of tea. I think they don't necessarily. I can understand it if you have an urgent need for privacy, but other than that, I think you want to get the listing into the eyeballs of as many people as possible. And private listings, I don't think accomplish that. Now, could be wrong. There could be data out there that says, John, you're wrong. And I'll say I'm wrong because I've been wrong before, as we talked about. But sometimes it almost feels like
credit spreads.
Yeah, I know, exactly. But sometimes, it feels like, who are you going to root for, Darth Vader or the Emperor? That'll just get the attention of the Star Wars nerds out there. So yeah,
R2D2. That's who I'm rooting for. Yeah, so let me know. Contact us, guys. I'm happy to moderate something and let those people talk about it and have your questions answered. Okay.
Yes. Someone asked, "What's your emails?" I'll tell you.
Noah and John at UrbanDigs.com. Couldn't be easier.
Well, it's not one email. It's not Noah and John. It's Noah at UrbanDigs. John at UrbanDigs.
Thanks, John.
We should actually have Noah and John. Why don't we have that? That would be handy.
Yeah. That's
that way I don't have to answer it. I could just say, I thought it was to you.
More emails. All right. Anything else? Are we good?
All good. Thank you, everybody.
Okay.
Hope you had a happy 4th, by the way.
Yeah. Thank you, everybody. Stay warm. Stay cool out there. Good luck on the deals. Thank you, John Walkup. I'm Noah Rosenblatt. This has been Macro Monday. Catch you guys hopefully tomorrow. Cheers, everybody.
Bye, everybody.